Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. It's a Friday morning, 11 o'clock. Markets are in profit booking mode. Benchmark indices have lost over 1%. The Nifty is below the 24,000 mark. In fact, below even 23,950 as it sees a deep cut of 300 points. Sensex down in excess of 900 points. For the week though, we're still up. The Nifty is up close to about 0.5%. The mid-cap index has gained 1.8%. And not to bear in mind from the April low, which was about, I think I'm forgetting the number, but we're up close to about 11% from the April low. So in that context, because the rally has been so swift in one way over the last couple of 2 weeks, that this is just perhaps profit booking.
Absolutely, just perhaps profit booking, and I think rightly so, because yesterday we did see some bit of a subduedness. Today seems like, we opened up on the green side, but then we started seeing that fall coming in. Nifty Bank also trading at the day's lowest point. We have the mid and small caps. The broader end of the market is seeing an underperformance coming in. Nifty mid cap is down almost 2.9%. Small cap also similarly is down 3.4%. Advance decline ratio today clearly is in the favor of declines versus advances. There's no doubt about that. Some bit of a bright spot that I would want to highlight that is there, and some of the stocks that are trading in the green today. We do have SBI Life that's managing to hold on to some bit of a green. They reported their numbers as well, so keep an eye out on SBI Life. We have IEX also. They reported their numbers. It was a mixed set of numbers that came in from the company, but volumes is the key that you keep an eye out on, where the management also joined us earlier on in the day as well. So keeping an eye out on IEX as well. Some stocks that are not doing well today obviously signed. MOSL, SBI Cards, Garden Reach are some of the names that are not managing to hold on to that gain in today's trading session. As of now, all the sectors, Rima, are trading in the red. So there's no green spot in a... actually, IT has just moved on to the green side. I would just like to pull up the Nifty IT and see where that's headed, because it was in the red a short while ago. Now it's come back to the green. So yes, that bright spot is only coming in from the IT side, Rima, but nothing exciting as a day coming in.
Okay, let's talk about the telecom sector then. Bharti Airtel, we understand from sources, has written to the government about its spectrum dues, which are worth 74,000 crore rupees. What CNBC Awaz understands is that Airtel is asking the government to convert these dues into equity like they did in the case of Vodafone Idea. So this provides Bharti Airtel some cash flow relief. Sanjay Kapoor, former CEO of Bharti Airtel, is now joining us on the show. Sanjay, first share your initial thoughts, because what we've learned so far is only from sources, but Bharti seems to have written to the government to convert spectrum dues into equity. What does this mean?
Yeah, so morning to everybody. And, I don't have much details than the ones that I have read in the media. And what I believe is that the government did convert the spectrum dues up to 2028 for VIL. So to bring in parity and to make sure that others have, a similar offering, probably, Airtel can also have the right of asking the government to convert their equity dues, their spectrum dues into equity. And I guess that's the bone of contention at the moment.
So Bharti Airtel may have asked, but is it incumbent on the government to convert and listen to the request, or can they refuse? And what could be the driving motivation for Bharti to do this?
So, whether the government can say yes or no, from a parity perspective, probably the government has always said they'll be fair to all players. So, probably they'll have to consider this option. But given the condition of Bharti Airtel in terms of financial strength versus VIL, government can always exercise its rights to say that, why can't you offload this in the open market and probably get a premium, right? Because Airtel doesn't have a funding issue. Airtel can go and sell this equity anytime in the market. They're a premium stock. So I guess government will always have the option of the refusal or the the last refusal.
Absolutely, they would have the right, because, and like you're mentioning, right, bringing parity, but Bharti Airtel does have the money to pay this dues, right? So if this actually takes place, then wouldn't they have a bit more advantage? And what would they be doing with the money that is already lying with them?
Well, telecom is definitely an industry where it's very capital hungry, and you keep investing money into networks and expansion. And Airtel will also be in the same boat to wanting to invest more monies into 5G. Reliance is investing more money in 5G. Does Airtel want to do that? Reliance has got a standalone 5G network. Do they also want to move towards a 5G standalone network? So I think they will have the strategies in place to say, why do they need this money? But they are well capitalized, and their ability to raise capital is not a question like VIL's. So I guess probably they're finding an opportunity here to bring in government. Though I would be a little coy about government's move here to say, will government, if they accept this, not become over-invested in the telecom sector? Though telecom sector is a very important sector for the country, and the government doesn't mince words on that. We need to keep alive at least three players in the market, if not four, for such a large market to give the right choices to the consumer. So I think from a government's perspective, they only seem to be over-invested, but for the right reasons maybe. But from Airtel's perspective, I don't think this is the only choice that Airtel will have to raise capital. They can raise capital in the market as well.
But that's the option they seem to have gone, with by writing to the government to convert, though they have other options. But then that brings the question that, Jio can also ask. They also have spectrum dues. So where does one draw the line? Because as you said, then there's a risk that the government is invested in the telecom sector.
Yeah, I mean, for now, what the government has converted for VIL is the spectrum dues. So I guess that Airtel is asking for spectrum dues and not AGR dues like some newspapers and print media has mentioned. Because if they do that, then that puts Jio at a disadvantage, because Jio doesn't have AGR dues, and then they might come back and say, man, how can you give it to two guys and not the third guy? So those controversies, I'm sure the government doesn't want. So right now, if it's spectrum dues, then Jio theoretically can come back tomorrow and say, me too.
Absolutely. But, Sanjay, do wait on with us. Actually, in a big development amid the tariff war, Apple aims to source all US iPhones from India in a pivot away from China. Parikshit is joining in with us to give us more details on this one.
Well, we know that currently the US has imposed tariffs as high as 245% on certain Chinese products. And the overall tariffs is almost as high as 145 to 150%. So considering the current tariff environment, the US is definitely considering importing more Apple phones from India. So this could mean that India may become a hub for manufacturing all Apple iPhones for the US market specifically. Now, while this is definitely the intent, the plan, a lot of this would also depend on the speed at which the capacity ramp up takes place at Apple's contract manufacturers here in India. And number two, what is the geopolitical situation? If tomorrow US and China come to sort of a truce in the trade war, then things could well change. But currently, looking at the tariff environment, this is the intent to make sure that all phones for the US market are made in India. In fact, the target that is being set, and we've learned this from industry sources, that Apple has set itself a target of 40 million phones production in India in 2025. Apple contract manufacturers in the country are ramping up their capacity in Bengaluru, in Tamil Nadu. In fact, we're learning that in addition to Chennai, where Foxconn is maximizing capacity, Foxconn's Bengaluru plant will be up and running very soon, perhaps in the next few days. And when at peak capacity will take some time, of course. When it's at peak capacity, Foxconn's Bengaluru plant will have a capacity of 20 million phones per annum. Now, Apple did not respond to CNBC-TV18's query, but we learned from multiple industry sources that Apple is maximizing production at its plants in India and would like to increase capacity and utilize whatever capacity it has in India for the advantage of the US market.
Thanks, Parikshit, for that. That's a big story that he's picked up. Sanjay, I know your domain is telecom, but you do look at the TMT sector as, at large. Do you want to quickly weigh in with your thoughts on this?
Well, I think it's a no-brainer that India is a great alternate destination for production of electronic goods, especially devices. And, India has really moved over the last few years. Though I did read in one of the print medias that, they have defined the norms for what will construe to be or what will qualify to be made in a particular country, and they have certain guidelines around components and critical components and design and all that stuff. So I guess we are on the right path, and if we can integrate more on developing the key components and design in India, then India could turn out to be a behemoth as far as production of mobile phones, especially Apple, is concerned. And Apple, over time, I think, has developed that confidence over here, and they are, along with Samsung, probably the biggest beneficiaries of the PLI scheme that the government announced. So I think they have benefited from the investment. They've benefited from our PLIs. They've benefited from the fact that India is producing quality products which can be acceptable to the rest of the world. So why not India become the key manufacturing hub for them globally?
Okay, Sanjay, thank you so much for joining in with us on the show, talking to us about the telecom sector as well as in terms of Apple iPhone and the updates coming in on that front as well. Thanks so much for that, Sanjay. But with that, we're going to actually sip into a very short break. And as we sip into the break, here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Trading Hour on CNBC TV18. Now let's shift focus and talk about the auto sector and the auto major Maruti, because that's set to report its Q4 FY25 earnings today. As of now, the stock is almost near the day's lowest point. But what are the key expectations? We have Sudarshan joining in with us for that. Good morning, Sudarshan.
Good morning, Vinny. So Maruti is expected to report earnings post-market hours today. First, talking about the stock performance, it's up 10% this year so far. Also, valuations after the recent correction that we have seen, like ahead of this year in the last few months, valuation has become supportive. It's currently trading at 23 times versus 5-year average of almost 28 times. So what are we expecting in earnings? First, it's going to be a steady set of earnings with volumes and rich mix will aid the revenue growth, while other increase in other operating expenses might weigh on the margin, which might see a minor contraction. Now coming to the headline numbers, profit is seen down 1%, revenue may increase by 7%, EBITDA too can increase by 4%, while margin can come in at 12% versus 12.3% in the same quarter last year. Now talk about the average selling price, or say realization. It's flat sequentially and it's up 4% year on year. Volumes were up 7% sequentially and up 4% year on year. And even raw material costs were flat year on year and sequentially as well. Gross margin too can slip 1% both year on year and sequentially. Now, what exactly in the commentary that we'll be looking from Maruti? First, if company gives any update on the order book and what's the inventory level, because talking about the inventory in the last few months, or say in the last 6 months, entire industry has seen an increase in the inventory because of the demand concerns. Also, what's the demand outlook for FY26? If you remember, just 2 months ago, in one of the conferences, most of the players for FY26 also were estimating growth in the range of 3 to 4%. So we'll see what exactly the company provides an update on that front, and if there is an improvement on urban demand, because rural has been largely doing better, and that can be that is being reflected even in the agri growth, or say tractor growth. But for PV, because Maruti is the leader in the entry vehicle segment as well, so now the comment on the rural demand will play the major role. And discounting trends. Remember, in the last few months, Maruti has taken price hike thrice, and still the discounting trends are being seen. So what is the current discounting trend? And lastly is the commodity price outlook, because that also has jumped in the last few months, and that is going to impact margin as well and overall earning. So these are some of the things that we'll be looking for in management's commentary.
Thank you very much for that. We will slip into a break on that note. We'll come back and discuss market technicals. Mitesh Thakkar joins in with his top trading bets. Welcome back. Let's talk about Tech Mahindra. Now, that's under pressure post their Q4 numbers. So one reason is the revenues were lower than street expectations, though Tech Mahindra has now recovered from the day's low. So first, let's get to the negatives. One, revenues missed street expectations, down 1.5%, lower than consensus expectation. Two, the stock had seen a very strong run-up prior to the earnings. So in the last 7 days, till yesterday, stock was up 13%, so some profit booking. But as we highlighted in the morning, there were lots of positives in the numbers too. One, margins were ahead of expectations. Two, it was the fifth consecutive quarter of a deal flow improvement to nearly $800 million. Three, the communication vertical, which is one of their largest verticals, that's 33% of their overall revenues, is stabilizing, and that saw a growth of 1%. And four, the company holds on to its FY27 guidance. They've said that FY25 was a base building year. FY26 will be a year of stabilization, but FY27 onwards, they do expect to achieve their goal of 15% operating margin and above industry-leading averages. So, which is why there were many positives in the numbers, and I think now the street is acknowledging that, and we've seen that recovery in the stock price.
Absolutely, Rima. But, there were a lot of mid-cap IT names also that reported this number. This was a busy week for you. Some hits, some misses coming in on that front. Overall, what's the roundup and sense that we're getting from IT companies?
Well, mixed. So, just to quickly, tell you the hits and misses. So the companies which beat expectations, one of them is Persistent, the other one is Emphasis. LTI Mindtree was in line, L&T Technology Services and Cyient were a miss. And you can see from the stock price reaction over the last 1 year that companies like Persistent, which were anyway outperformers, they were commanding premium valuations because it was able to deliver growth ahead of peers. They continue to do that. And the companies which were struggling, like Cyient, for instance, they have underperformed. So in a way, like the men are the men and the boys are the boys. And this, Coforge is the other one we're awaiting, and those numbers are only on 5th of May, and that stock has also been quite the outperformer, 40% up in the last 1 year. Now let's get to the growth numbers. Now, Persistent was the big outperformer, 4.5% revenue growth ahead of estimates. Emphasis too delivered on estimates, 2.9%. Now for LTTS, you can see it looks like a big 10% kind of a revenue growth, but that includes the IntelliSwift acquisition. Actually, LTTS was a miss on estimates, and the stock post earnings declined, and Cyient also disappointed the street. Now on to the guidance for the full year. Persistent is still talking about beating the industry growth rate in FY26. They also hold on to their FY27 annual revenue guidance of $2 billion, $5 billion by FY31, improving margin. So holding on to their long-term, medium and long-term guidance. Emphasis too, margins will be maintained in a narrow band. And again, they expect growth to be above industry leaders. Now, LTTS is just saying that, and normally LTTS gives you a numeric guidance. This time they're not. But they're saying FY26 to be better than FY25. And they're also saying it will be a double-digit revenue year. But even then, it's slightly lower than what analysts were hoping for. They were looking at a high double-digit, mid to high double-digit kind of a guidance for this year. So in that sense, it's a bit of a miss. Cyient is abstaining from giving a guidance for FY26. They expect the uncertainty to last through the first half of the year. And even their margin aspiration has been lowered and pushed forward.
Okay.
So that's the reason why Cyient is under pressure.
Absolutely. A lot happening for Rima during this week as well. Maybe sip on some water after the whole roundup of mid-cap ITs that's come in from Rima. Interesting, mixed is what we're watching out for, is what I'm understanding from Rima as well. But let's move on and talk about banks, right? We have Axis Bank that reported their numbers. Now, the stock is under pressure today. What's leading to this? Abhishek is joining you with us to give us the review in terms of how Axis Bank performed in Q4. Abhishek.
Well, Axis Bank saw weak business momentum on a YOY basis. Take a look at deposit growth. It's just 9.8% YOY, perhaps the second lowest that you are seeing in last 16 quarters. Sequential business momentum saw a bit of uptick thanks to deposit growth of 7% quarter-on-quarter, which was one of the best in last 8 quarters. However, advances growth disappointed. So advances growth was at 7.85% YOY, which is perhaps the lowest growth that you are seeing in last 16 quarters. And sequential growth in advances was about 2.6% quarter-on-quarter. Now, what disappointed in the loan growth was the housing finance sector. segment and the auto segment. So the housing sector and auto sector, both of them saw their loan book decline on a sequential basis. Cost to income ratio or operating efficiency was one of the worst in last 5 quarters. It was the highest at 47.8% versus 46.2%, the highest that you are seeing in last 5 quarters. Slippages were the heartening point, 4,800 crore. We saw a decline of 11.5% quarter on quarter, and thanks to highest write-off in 16 quarters, asset quality improved for them. So gross NP ratio came down to 1.28% versus 1.46%, perhaps the lowest that you are seeing gross NP ratio in last 39 quarters. Now risk-weight asset to advances ratio, that increased to about 111.4% versus 109.8% in the previous quarter. It is at a 5-quarter high and does not augur well given the fact that risk has been built in the balance sheet a little on a sequential basis. The PNL NII was in line with our poll. However, the PAT on account of lower provision beat our poll. Back to you.
Okay, Abhishek, but do wait by because SBI cards, that also reported its number. It's down more than 6% as of now in the trading session. What are the numbers looking like for SBI cards in Q4?
Well, credit cost was actually continues to impact SBI card. It remains on the higher side despite the fact that it's improved slightly on a sequential basis. So take a look at quarterly spends. They are up nearly 11% YOY and about 2.5% sequentially. However, the receivable per card, that's declined both YOY and quarter on quarter. So card receivables, that is AUM, is up only 9.8% YOY and close to 2% sequentially. The net interest margin improved for them after many quarters. So it improved to 11.2% versus 10.9% in the same quarter last year and about 10.6% in the previous quarter. The annualized credit cost remained elevated at 9% when compared to 9.4% in the previous quarter. The revolver rate continues to remain low at 24% flat YOY and quarter on quarter. The NII growth was 7% YOY and about 2.3% sequentially. The PAT declined by 19.35% YOY and grew by 39.4% sequentially. In the con call, the management has mentioned that, a 6 to 7% credit cost range in the foreseeable future is actually very far for them. Back to you.
Okay, Abhishek, thank you so much for that. Surely we'll be keeping an eye out on SBI cards as well as of now at the day's lowest point. But let's bring on board Mitesh Thakkar, who's joining in with us to give us a quick check on the technical front on the market. Mitesh, good morning. And right now, just a short while ago, we saw that the Nifty actually went to the 23,900 mark and then has seen a bit of a bounce back again coming in. What are the levels that we should keep an eye out on for today? And, from which point do you see a further fall coming in now?
So I think on the index, this is the level which I was hoping will hold. 23,870 to about 23,900. We made a low of around 23,879 and practically there. So there's a gap which happened on the Monday morning, and this gap should be acting as a good support level. In case it gets filled, then we might have a bit more dip to about 23,665. But for the timing, I'm hoping that this gap holds and we kind of end the correction over here. But the idea is that next few days could be spent consolidating. We've had a good rally. We've had a pullback today, a decline in profit booking led kind of a thing. And the indicators are coming out of overbought levels. So next few days might be choppy. I would hope that if 23,870 holds, then we might do a range of about 23,870, 890 to about 24,400. In case we have a dip, then I think we might see another 150 points on the upper side.
Thank you very much for that. On the other side, we'll talk about the global economy. Brian Coulton from Fitch Ratings, who recently, I think in the middle of April, had lowered the global GDP growth forecast, citing the tariff uncertainty and the Trump tantrums. We will discuss that when we return on the other side with Brian. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18. Now shifting focus to the global macros. Now credit rating agency Fitch has sharply lowered its forecast for global growth as escalating trade tensions weigh down on the growth prospects. They have slashed the world growth in 2025 by 0.4 percentage points and China and US growth by 0.5 percent points versus their March global economic outlook, which was much higher. So to discuss all of this, what is the indication that they're picking up further as well? We have Brian Colton from Fitch Ratings joining in with us to talk to us about that now. Brian, good morning. Thank you so much for joining in with us on the show. I just want to start by talking about the cuts that you all have given so far. What is the worst case scenario? Is this the worst case scenario? And if negotiations that, many countries are having with the US, if that goes through, then what is the upside also from this that we could see? If you could tell me both the parts of the story.
Yeah, I don't think we're so focused on the upside at the moment, really. I mean, what's transpired in the last 6 weeks has kind of been worse than most people's worst case scenarios as of like 3 months ago. So we just need to bear that in mind. I mean, we're at this 10% rate now on the reciprocal tariffs have been moved down to the 10% floor, but that's only temporary, remember? So there's got to be progress within the 90-day window for those not to revert to something higher. Now, hopefully there will be some progress, but that is ahead. Trump has also talked pretty explicitly about new sector tariffs that are coming down the pipe on pharma and semiconductors. So those weren't part of the Rose Garden announcements, but they are to come. I think where we're currently at extreme levels, where probably over the next 12 to 18 months we'll see some improvement is the rates that we've now reached on China, which are just spectacular. This 145%. That's the sort of tariff bill that's going to completely disrupt trade, and I think the US has now come around to the view that maybe that all got a bit out of hand in terms of the escalation, and that's going to cause some real damage. So I think there is some prospects for coming back from these extreme levels on China, but nowhere near where we were before. We're assuming in our forecast that rate comes back, but only to about 60% on China.
So what are the global growth numbers now? If you could give that for the, on the whole, how has it changed after what we've heard so far on the tariff front, and even for the key economies like US, China, the Eurozone, and throw in India as well?
Yeah, so the backdrop is the world economies did pretty well in 2023, 2024, right? We had global growth of about 2.9% last year. That's above the long run trend. But with our latest revision, we're now seeing global growth fall to 1.9% this year. So below 2 is a pretty weak number. If you exclude the pandemic, the last time world growth was below 2 was in 2009. So we've got Chinese growth falling to just below 4% this year from 5% last year. US growth from about 2.8 to just 1.2 on average, and through the year in the US, Q4 on Q4 year on year, we've got that a point at 0.4, and then the Eurozone, has really been struggling since the Russia-Ukraine gas crisis. It's just been kind of like trundling along at rates below 1%, and we've got growth slowing to about 0.6, 0.7 this year from 0.9 last year. So India is still a global standout, with rates 6.5% range. We don't see it being as affected, but there is going to be some negative impact on India as well.
There will be some negative impact, but for India, but not as much as other EMs is what you're talking about. What about the flows into EMs overall as well? Do you think that could maybe see a bit of a shift or a pause on that front as well?
Well, this is definitely a risk-off environment that we're in now with this global trade war. So all else equal, that would be negative. We are looking at lower global growth. We're looking at lower Chinese growth. We're looking at lower commodity prices, and all those things historically have been associated with weaker capital flows to emerging markets. On the other hand, we have seen some recent weakening of the dollar, which tends to be a bit more supportive of emerging markets. So I think net, I wouldn't say this is positive for EM capital flows, but it could be worse.
You said US growth to slow down to 1.2% in 2025, which compares with 2.8% last year. Did I get the numbers right?
Yeah.
So that's a very sharp slowdown, and yet you don't expect the Fed to act very soon and with deep rate cuts.
Yeah, I mean, that's quite a striking feature of these revisions. You know, we slashed our US growth forecast, but we stuck with our view that the Fed would have to wait until the fourth quarter of this year before they were going to cut rates. And that's really all about the adverse supply shock implications of this tariff hike, which will push up prices in the US and restrict supply. And that's on the figuring that we've done. We've got the US inflation rate heading up above 4% by the end of the year. We've got a 4.3% number for December for US CPI. So that's taking the Fed a lot further away from where they want to be on inflation. They hadn't got inflation all the way back down to 2%. It's going to be moving sharply in the wrong direction. And then separate to that, which is also very relevant for the Fed, has been this jump in household sector inflation expectations, which is a real threat to Fed credibility. And we think in the context of all that, even though the Fed will be lowering their growth forecasts in the next meeting as they digest the impact of the tariffs, we think that they're going to be cautious and cutting rates too soon, and so we'll kind of hang on, keep rates at the restrictive level until the fourth quarter. So yeah, it's not a great combination when growth is deteriorating, but you can't cut rates.
Absolutely, that is what everyone will be keeping an eye out on when not seeing much growth. Fed is not cutting rates as well. But Brian, when I'm just talking about Asian countries, specifically, they have a higher exposure, right, in terms of exports to the United States. And that is why these trade talks which are going on are key for them. But how do you see overall EMs in terms of performing, specifically with higher exposure, something like a Vietnam versus China and India? Do you think Vietnam would maybe have an upper hand, or if trade talks, what do you see that in moving in terms of that?
I think it's got to be complicated because, one of the things that happened in the first US-China trade war was this trade diversion, because it was just between the US and China, it became profitable for firms to sort of redirect their export and supply chains, through other countries. But the US administration is kind of all over that, and they don't want to see that happen again. So it's going to make that trade diversion, which did certainly benefit some countries, and Vietnam was definitely in the list there, and Mexico as well, but also other countries in Asia. It's got that trade diversion, which was a benefit. The China plus one strategy as well that we've heard a lot about. It's going to be a lot more complicated in this context because it's such a broad-based increase in US tariffs.
So, Brian, just to circle back, right, the numbers that you've shared with us in terms of the global growth forecasts, this is assuming what base case is tariff? On China, I think you said 60%. Is that correct?
No, we're assuming that the effective rate we think at the moment is about 100% once you account for the carve-outs, electronics and other stuff. We think it's going to remain around that level for some time, for quite a few months. And then it's going to come down to 60%. That's the assumption we're making. It's going to come down to 60% by the end of this year, start of 2026. For the rest of the world, we're just assuming something like 15% average tariff rate.
Okay, so China starts with 100%, comes down to 60%, and for the rest of the world, the base case tariffs should settle on an average of about 15%.
Yep.
And the global growth assumptions are based on that.
Yes, yeah.
Got that. Brian, pleasure speaking with you. Look forward to more conversations. Thank you once again for joining in and sharing your insight. Well, we'll slip into a break. On the other side, we'll discuss market fundamentals. Anirudh Garg from Inva Asset PMS joins in. Welcome back. All eyes will be on big boy Reliance Industries, and it's expected to be a fairly steady quarter for them. In terms of the pure numbers, top line growth seen up 1% quarter on quarter, 2.42 lakh crore. Year on year, the growth should be higher at about 2.5%. EBITDA is seen likely flat at 43,800 crore, which means margins mostly unchanged at 18.1, 18.2%. So what will be the drivers? On one hand, quarter on quarter, Jio will do well. That's the telecom business. That's because of the tariff hikes which the company took in July. There will be the residual impact. Also, Jio, compared to peers like a Bharti Airtel or a Vodafone Idea, has a higher percentage of annual recharge customers, which means even in the current quarter, there will be customers who will recharge their overall package with the higher rates. And therefore, ARPUs are likely to improve, and this will drive Jio's performance. So Jio is going to have a good quarter in Q4. But on the flip side, retail will be subdued quarter on quarter because remember, December is a base festive quarter. So compared to the December quarter, numbers will always be weaker. Year-on-year growth is seen about 10 to 11% according to some estimates. Now, oil and gas is likely to be subdued. That's on account of lower volumes. O2C could be a bit mixed. Cracks are lower, but GRMs on account of better sourcing could inch up, on a quarter-on-quarter basis. So these are the key numbers. But the stock hasn't done too much. Right? It's been a bit of an underperformer. And also analysts are pointing out the stark difference between, say, a Bharti and Reliance. Right? Now, Bharti Airtel is pure telecom. Jio is a part of Reliance Industries. But Bharti Airtel in the last 1 year is up 40%, while Reliance Industries is down 10%, which means Bharti has re-rated vis-a-vis a Reliance Jio. So what is the street really watching, which can re-rate the stock, is the retail performance. So a lot of the analysts said that it was the weak performance of retail which has dragged Reliance down. So they want retail to come back to the growth trajectory, and that would be the key. And then you watch for other things like, the green energy commissioning, your capex, because if the capex intensity is coming down, your cash flows improve. So, but retail is going to be the key kicker in terms of re-rating. And secondly, if you do hear anything on monetization, that of course will be, much anticipated, and not anticipated is not the right word, but something everyone's watching and waiting for.
Absolutely key numbers to watch out for as well, and all the details over there. Thank you so much for that, Reema. Surely we'll be keeping an eye out on that. But on to a specific businesses now. So Darshan is joining in with us to tell us what to expect from oil and gas and O2C side of the business as well. So Darshan.
Two of the major divisions of Reliance Industries, O2C, that is oil to chemicals, and oil and gas, are estimated to report a mixed set of earnings for the fourth quarter of fiscal 2025. For O2C, while decline in diesel cracks and polyester margin may impact negatively, the weaker rupee against dollar that we saw in Q4 to an extent can offset the decline. And this may lead to a minor uptick in gross refining margin on a sequential basis. But year-on-year, there can be a fall. GRM for Q4 FY25 is seen coming at $10.80 per barrel. For oil and gas, lower volumes at KG-D6 basin, which were down 4% sequentially and 9% year-on-year, likely to have a drag on the results. And as far as gas price is concerned, it was flat on a sequential basis and was up 2% year-on-year. Now, talking about the headline numbers, from Bloomberg estimates, for O2C business, revenue is seen rising both sequentially and year-on-year, while EBITDA and margin can see a decline on a sequential basis. EBITDA can fall nearly 2% and margin around 40 basis points. For oil and gas, both revenue and EBITDA are expected to slip nearly 3% each, and margin can be flat sequentially but hold on to levels above 87%. But in the recent past, we have seen that Brent crude has seen a sharp fall, but in the last few days, it has again moved higher. So we'll have to see overall what impact that it will have on the earnings of Reliance Industries.
Absolutely, Sudarshan. Thank you so much for that. That's going to be more in terms of, business specific that Sudarshan highlighted as well. As of now, Reliance is trading almost in the day's lowest point, down 0.7%. But let's bring on board Anirudh Garg, partner and head of research at Invest PMS, joining in with us to talk about the market on the fundamental front as well as sector-wise. What is he finding attractive? Anirudh, good morning. Thank you so much for joining in with us on the show as well. What have you made of the earnings so far? We had so many IT companies come out with their numbers as well. Reema did give us a roundup a short while ago. Today we have Reliance in terms of heavyweight reporting its numbers. Any thoughts on both these things?
Thank you and very good morning. I think the earnings are more or less in line with the expectations that everybody had. Our focus is primarily both the sectors that you talked about. I consider Reliance as a sector only in India. So IT and private oil and gas, I think both these sectors are not the flavor as expected. We see traction in other sectors actually right now.
Okay, traction in other sectors that you find as well. Which are these other sectors that you're liking? And, given that global scenario that we're seeing as well, right? The possibility of tariffs, we don't know where that is headed. Domestic front issues also going on. So how are you seeing overall in terms of a picking of sectors? What would you prefer right now?
Okay. So first of all, when we talk about the global macroeconomic scenario and the domestic scenario that we have on the LOC as well. So my experience of the last 16, 17 years has told me that whenever there is so much confusion, just focus on the growth. So we are focusing on growth, and where expected growth is for the next 2 to 3 years. The first sector that we like, it is our CDMO and the CMO sectors. Look at the Loris Lab results yesterday. They were in line with expectations and phenomenal. And we are expecting the same for other companies into this field as well. Apart from that, we like stock market intermediaries, all these into financial market infrastructure, be it an exchange or a depository or a good broker or a wealth manager, because somewhere the re-rating of this sector is being done. It has been done a lot, but I think there is still more steam to go as the market is, and the Indian market and the retail is developing over time. We've seen a significant shift from the FD culture to, the equity culture. Apart from that, the more these confusions of the global macroeconomic front arise, the more opportunities also arise. So if there is tariff war going on, we have to look for those companies which can benefit. So we are focusing on leaders of various sectors which have possible benefits out there. So something like a textile is one of those factors. And somewhere all this confusion has led to a good, healthy correction in the market. And leaders of various sectors, be it consumption, be it defense, be it retail, all these companies are available at a massive discount right now. So I think we are in a comfortable zone. And if we have a 2-year vision from here, I think a good, healthy double-digit plus return will be, a CAGR will be seen.
Anirudh, is Reliance a part of your recommended stocks? It's such a large cap, and it's such a large weightage on the index. And what would drive an outperformance from here on for Reliance Industries? What exactly are you watching out for when it comes to the numbers this time?
Until and unless we feel that the markets are superbly expensive and we need to take a shelter, we do not go into these big shares. So our focus is generally to find those, I would say, mid-cap stocks that would, in a couple of years down the line, or maybe 4 years down the line, would convert into a large cap. So we never hold stocks like Reliance as per se, until and unless there is an extraordinary opportunity to be seen. We do not find any extraordinary opportunity in Reliance, for say. I think it's a healthy company, but too many businesses, and sometimes it gets a little bit, you get away from the track. They're into good businesses, but these businesses take time. And apart from telecom, I do not find any business for Reliance, especially in the scenario that we are seeing crude, not bullish on the crude for the next couple of years. So we are not very bullish on Reliance from here. But I think, it will be a market performer, not an underperformer or an overperformer from here. There are much better opportunities out there.
Okay, much better opportunities that are there as well. Earlier we had my colleague Parikshit, who actually spoke about, Apple having more of the production in India. So is that a story that you would be looking to play? Is there anything on that front that you find exciting as well?
When we look at we call it neighbors plus one, not just China plus one. So we are seeing a lot of traction in textiles when it comes from the problems in Bangladesh. Yeah. And the trust factor, India has the trust factor, but along with it, the reality on ground is that you need companies and sectors which have developed over time. So if we see in India's, the easiest way to look at it is what are the sectors that have led the previous bull runs in India. Those were the sectors which have, developed over time. So be it textiles, be it IT, be it pharmaceuticals, these are the sectors that India specializes in. And now when there is a global opportunity, these will be the people who will be first and early to capture those. For example, something like a semiconductor, there is an opportunity there, but India does not have the required infrastructure right now. Infrastructure will come with time. So let's focus on those companies which are already having a footprint and specialize in what they do. So since there is an opportunity, I think in reality, these will be able to capture them better.
Okay, and Anirudh, I was reading some views that came in for you as well. You were earlier saying that you re-entered the market, you booked your profit in the small cap and the euphoria that we saw last year. You booked your profits that time and then you re-entered the market somewhere around the 22,000 levels. Right in the last couple of days, maybe also we're seeing some bit of a profit booking. So your overall thoughts on the market, if you could just leave us with that.
So the reason for us exiting the markets was firstly the valuations were very, very high and everybody knew that. Along with it, what we focus a lot is on behavioral finance, and we could see a lot of exuberance in terms of the greed that we saw in people, especially our clients, even us as fund managers. So we have our quant systems in place which are able to capture it in a better way. So we took an exit call in December and we entered at the 22K levels because both the sides flipped. The valuations were comfortable. We were getting the portfolios 30-35% cheaper. The small cap, mid cap index were 20-25%. The Nifty was around 20%. So this is what we look into. And the greed that was there has turned into extreme fear now. Trump tariffs. The situation at the LOC, there is a very simple rule, and it has helped us over the years, that markets in a bull run, they feed on bad news. And as I was talking to one of your colleagues as well, that to make solid bottoms, you need a good bad news, if I may say so. So a strong bad news, if that's the right word. So I think we are in a period of consolidation, and each dip that comes now, because the valuations are okay, there is no greed in the market right now. So somewhere we should be entering at lower levels. Every opportunity, every dip for us is a buy right now.
Every opportunity every dip is an opportunity that comes into buy. Anirudh, one more thing I just want to talk about, a sector that you've spoken about, you're highlighting is financials, right? So I want to understand in financials, what are you finding exciting now? We have HDFC, ICICI Bank, which reported a good number. Axis Bank on the other side, not that great, right? AU Small Finance Bank in its con call mentioned about how those MFI issues are easing now. So what are you liking in this space specifically on the financial side?
Okay, when it comes to the finances, we are liking the leaders right now. So we like the public sector banks, especially the bigger ones. I think even with the Axis Bank not having numbers as required, I am still not bearish at the bank. I believe that's a very good management and things will get better from here. When it comes to the big heavyweights like HDFC or Kotak or an ICICI, wonderful numbers, wonderful technologies being in place. I think we have the best managed banks in the world. And apart from that, quality NBFCs also. Something like a Bajaj Finance. Disclaimer that we may have positions here and we may increase or trim them anytime, but not a recommendation to buy and sell. But yes, all these quality NBFCs are also looking good from here. So for us, finance is a major part of our portfolio, and we are bullish on finance for the next couple of years.
Thank you very much, Anirudh, for joining in. Need to get into a break on that note. On the other side, we get you the latest related to the Pahalgam terror attack aftermath. Stay tuned. In the aftermath of the Pahalgam attack, India sends a formal letter to Pakistan stating that the Indus Water Treaty will be held in abeyance. Pakistan terms it as an act of war and suspends all trade with India and even closes Pakistan airspace for Indian airlines. All bilateral treaties with India have been put on hold. Parikshit now joins in with the latest updates.
Well, yes, India has been retaliating. It has been inviting foreign envoys to the Ministry of External Affairs, briefing them about the linkages of Pakistan-based state actors to the terrorists who carried out that ghastly attack in Pahalgam on civilians. Having said that, we're looking at complex military exercises that are being conducted by the Indian Air Force. Sukhoi fighters from all across the country are being deployed to carry out those exercises, those complex maneuvers as well. The INS Surat, the Navy carried out a missile test, an indigenous test also that happened yesterday. We're also looking at India and Indian forces retaliating at the LOC wherever the Pakistani forces are opening fire at India. There are anti-terror operations taking place in Jammu and Kashmir. We've sent a formal letter to Pakistan suspending cooperation on the Indus Water Treaty, and the letter by the Water Resources Secretary clearly states that the continued use of terror against India makes it absolutely impossible for India to meet its obligations under the treaty, and the circumstances have significantly changed since 1960 when the treaty was signed. So multiple efforts being done to corner Pakistan.
Okay, Parikshit, thank you so much for that and giving us the latest update over there. But a quick look at the market, 23,850-60 levels is what the market is trading at as of now. So 23,000, below the 23,900 mark, almost at a day's lowest point is what we're seeing the Nifty trading at, 370 points down in today's trading session. Banks also continue to be a bit under pressure as well. But that's where we'll end this edition of Trading Hour on CNBC TV 18. Thank you so much for tuning in. Stay tuned in. Up next, you have Halftime Report.